intuition can be trained. Right? Nurses who use intuition to make diagnostics and use stuff that's not necessarily on a pure diagnostic checklist, the research shows they outperform just the pure checklist approach. Why? Because they've seen it before. They've seen, I noticed this pattern of things and I'm going to suggest we try this. It's the same thing in private markets. And so where does intuition be trained? Intuition can be trained when you have clear and unambiguous outcomes, when you get rapid feedback, and when you get lots and lots of trials. Well, you can have clear and ambiguous outperformance or underperformance. You can get lots and lots of trials. I mean, I'll get 100 emails a day. But it's that rapid feedback that's harder to get, which then just means you need more repetitions because you need to see something as it evolves. Back to the why LPs want to look at something for 3 years, because I can see what you do and what you said you were going to do. This is held at 2x, but we know we're going to sell it at 3. Do you come back a year later and sell it at 3 or sell it at 5, or do you sell it at 1.8? So that, that intuition, it's really pattern recognition that needs to be informed by lots and lots and lots of reps over time.
Hey everyone, welcome back to the Ignite podcast. Today we're delighted to have Chris Schelling on the program. He's Managing Director of Private Investments at Caprock. He brings 20 years of experience in alternative investments and an impressive record of due diligence on over 100 funds across not just hedge funds, but real assets, private equity, private credit. He's known for his expertise in behavioral finance and a commitment to client-focused investing. He's a published author, has an interesting newsletter. He's managed commitments of over $7 billion. Very impressive, Chris. Welcome to the podcast.
Thanks, Brian. Appreciate the invitation and the very generous introduction.
You're welcome. I used to not do the introductions. I used to just sort of have the guests introduce themselves. And then I realized, you know what? I should just introduce the guest. They don't have to talk about themselves right off the bat because you're going to be doing that the rest of the episode. I'd love to hear what first sparked your interest in finance and alternative investments.
Sure. I kind of got introduced to investments within finance in my MBA program. A professor there is now, J.D. Kurish, he's now the dean at Emory with a great background, applied academic, PhD, MBA, undergrad in psych. He really made it clear that investing was this sort of intersection between the behavior of market participants, and my undergrad was psychology, so I love that. And then also this kind of element of statistics and math, and I had an aptitude for that. So he really made it come to life. And alternatives specifically, like to me, they're really this creative destruction edge of capitalism within the investment industry, where smart people are trying to find new things, trying to disrupt like the incumbents. And I think you really like sort of need that to keep the investment industry like fresh and competitive. And so I've always gravitated to learning about those new strategies and things.
Yeah, it seems that there's an old phrase that marketing ruins everything. Like it kind of penetrates something and ruins the channel. Eventually it completely saturates. And I guess you could almost say the same about finance. It kind of saturates everything and pulls everything to like market averages. What do you think about that?
Yeah, no, I would say that's correct. I think when you look at the asset management industry in general, the benefits of scale that accrue are to huge strategies that can scale, where you can sell, right? And you're becoming like excessively financially engineered. And there's a lot of margin in those businesses. That's not where my kind of aptitude has been and where I've been gravitated. And it's more the stuff that doesn't necessarily scale, which makes it harder as an allocator, right? But it's where there's interesting things that actually have value and a reason to exist.
Yeah, and I love your background in psychology. I remember finally getting exposed for some reason in college. I never took any psychology courses or sociology. And I remember thinking when I finally started reading some books after I graduated with a degree in finance, I was like, wow, I probably would have majored in this stuff. It's really interesting.
That's what investing is to me. It's the behavior of market participants collectively. Physical science have applications that you can use in terms of like quantitative finance, but it's not a closed form solution. It's a social science. And probabilities matter as opposed to like, definitive closed form solutions math. And to me, that's like interesting. I think it's hard for people to kind of think probabilistically, but that's really what's happening in the markets.
Yeah, I remember somebody came in and gave us, I think it was like Investments 400, fourth year of college. And he kind of came in and he kind of drew this pendulum. He's like, there's fear and there's greed, right? And it kind of just goes back and forth in the market.
Yeah, it's all behavioral. It's all behavioral activity of market participants. It really is. We're neither perfectly rational like Homo economicus, like the perfectly ideal rational decision maker, but we're also not just purely Pavlovian reactive robots. Like we're a combination of the two. And so I've always thought one of the first lessons you learn is past performance is not predictive of future results, and that's true. But the strongest predictor of future behavior is past behavior. And then like the next strongest predictor are incentives. And so if you can really distill investment activity down to its behavioral inputs, like you have a better chance of understanding what is the next behavior going to be and how does that impact your future returns. So it's like putting that picture together to me has been very insightful of understanding like what happens in markets.
Yeah. And I actually read recently that I think they're looking at studies of venture capital, which is my industry, where past performance is actually predictive. Maybe you could speak a little bit of that about that if you've kind of looked into different asset classes and how that might be true for venture where it's not for others.
I mean, that's partly why I've gravitated to private markets over the last 10 years or so. I mean, I started in public markets / hedge funds, and I've come to realize that it is more predictable in private markets. Private equity, venture capital have the strongest persistence of returns. So alpha, excess of returns, but it exists at this intersection of persistence of that excess return and higher return. If you just get higher returns and it's sporadic, like there's no point, you bought somebody else's alpha. You want it to persist. And behavior drives more of the outcome in private markets because there is no market, right? There's this sort of perverse thing. The more liquidity you get, the more sentiment matters to your return profile. The less liquidity you get, frankly, sentiment is less impactful. And so the decisions are slower and longer term, and actual value creation is what drives those returns. You can see it. You can see it in like, what's the percentage of value come from top line growth or earning growth in the private markets versus public markets. Public markets are just more multiple driven. VC and PE in particular have the highest persistence of returns. And the interesting research recently shows it's not the brand, right? So research 20 years ago showed, KKR, Apollo, Sequoia, it was affiliated with the brand. And then more recent research showed that declined. And now it's not as predictive. But then there's even subsequent research that shows, well, if you look at the people, what's happened is people have left the big shops and started up their own shops. The spin out activity is more prevalent today than ever before. And if you do deal attribution, the persistence is 4 to 5 times as powerful as it is at the firm. And so it's still there. It's just you got to look harder to find it because people do deals, not companies. I think it's the area of investing where you can actually control your outcomes better.
That's really interesting. So it's actually the people, and the people used to be affiliated with firms for their entire careers. That was very much a thing, 30, 40 years ago. And now it's become much more prevalent to see these, $50, $100 million spin out kind of funds where they're like, hey, I'm doing all the great deals. Why am I giving away half my carry to my partners?
Or more. I mean, if you were on the partnership track at a lot of those firms in the 80s and 90s, like you're like, this is a great gig. But I mean, most of those big name brand firms still have founders today that are involved in some capacity or another. And so once you became trained up, you understood the economics of how it worked. It just made sense to go try your hand. And today, every fund one in market, almost every fund one in market has a pedigree at a prior firm, at an institutional shop where they learned that's not the case. 20 or 30 years ago, fund ones were coming out from a bank or just kind of the proverbial two guys and a Bloomberg spinning out. Today, they're all trained up. So they are professional, they are institutional. And that's changed that dynamic that shows up in the persistence.
Yeah. How do you think your early experiences at firms like Ameriprise and Calamos and others kind of shaped your unique perspective on the industry?
Ameriprise was a relatively short stint, but Calamos, I was there for 2 years. And I think the two big lessons that I took from Calamos are, first, John Calamos was a broker and an investment advisor in the 70s, and his big realization was that convertible bonds were an underappreciated asset class. And he led clients to significantly commit to that asset class. And what happened? Well, rates went from 15 to 7 in the 80s. Converts caught that. The NASDAQ went from 1,000 to 5,000 in the 90s, and converts caught that. So one big realization of an asset class allocation decision led to 2 decades worth of massive wealth creation for their clients. And I mean, today, Calamos is much bigger multi-asset firm with a competency in convertibles and liquid alternatives. But like the importance of that thing, right? That's partly why I became an allocator, because it just drives so much of the investment outcome. But the other one was looking for asymmetry in returns, right? Convertible bonds literally have debt-like downside and equity-like upside, and they caught both those 2 decades. And so I've always searched for other investments that have the same sort of thing, whether it's structured royalties, mezzanine, event-driven in the hedge fund space. Anything where you get, asymmetric upside, optionality embedded, you get paid to hold an asset, and you get equity upside, those are the best investments.
Switching to your expertise in alts, you've conducted due diligence in over 100 funds. What are some key red flags and green lights you look at during your due diligence?
There's lots of big red flags, but I'd say lots of little red flags are, lack of personal investment in the fund. I mean, if you've got for your own personal net worth, I mean, it could still be a small dollar amount, but if it's meaningful to you, that's more of a green flag. So lack of personal investment, I'd say misaligned.
What
fees.
percentage of someone's net worth do you look at? Like, I think that's a case by case, but
It's got to be a case by case. I mean, there's been good private equity firms that have launched where they didn't have any like really liquid net worth to speak of. They were making capital commitments on like credit cards and stuff like that. So you really have to do it on a case by case, but it has to be meaningful to them. It has to be a true opportunity for them to create upside. You can't just look at 2% commitment or a 4% commitment into the fund. You've got to dig a little bit deeper than that. And I think there's actually an area where too much of a commitment changes the risk return profile, and what you see is just lower risk taking. So I think it's more nuanced than just what's the total dollar amount, but it really has to represent a significant personal wealth creation for the founders.
That's interesting. Does that differ across asset classes, you think, or is it kind of roughly the same?
I'm sure it probably does, but I think roughly speaking, if you have created a ton of personal net worth, a lot of that is invested in your fund, right? You have just less of an appetite for incremental risk. And so the risk taking kind of declines. You see it in big funds in private equity, right? The dispersion between all of the funds that are $1 billion, it starts to decline and they all start to look more alike. I think you have to find the right alignment relative to what that strategy is. Like higher risk, you definitely want more of a personal investment, but not too much. And then more of a debt-like strategy, it's okay to have more capital preservation on behalf of the manager because that's what you want from the strategy.
And some of these different asset classes have different horizons, right? Like PE funds, my understanding is they're 3 to 5 year funds, 5-year funds, and venture capital funds, of course, are really long now, 10, 12 years plus.
14, 15 years, that's right. I mean, it's not just the alignment on the personal investment, but it's also on the fees and like the structure of all those underlying things. When do they get carried, right? Is it only when it's capitalized? Part of that, my belief is part of the problem with hedge funds is for a long time, you got annualized carry paid to the GP, even if you weren't getting any capital distributions as an underlying limited partner. And so it's
that's interesting.
Misalignment.
Yeah. So like you basically have paper gains in the fund, in this hedge fund, because you're up, I don't know, 30, 40% on your strategy. And you're like, okay, I'm going to liquidate some positions to take my carry of that 40%.
Well, the hedge fund probably had actual realized gains because they were trading. And so part of it is a disconnect between the structure and the fees. But I've always that's always struck me as not perfectly aligned, and it's changing. I mean, there are things where it's like 3-year look backs and different ways to sort of not make annualized crystallizations when there's no distributions to the LPs. But it's important to like make sure that there's a match between what you're trying to accomplish and how the underlying manager's incentive back to incentives.
Yeah. So if you're looking at one of these new GPs that spun out of a firm, they probably have some money put together. They're raising some numerical value of the fund. What percentage of their net worth do you think should be tied up in this new fund?
So again, that's tough. I mean, that's tough. It's got to be meaningful to them. I mean, if you're putting 100% of your net worth, that's huge. That's probably too much, right? That's way too much. 25% or less. I mean, it's probably not enough. Like you want these people to be really incented, and it doesn't have to be into the commitment, right? Because a lot of times they're floating employees off their personal balance sheet. Like they're putting capital into the operating entity to hire an office or rent an office, hire people, and that costs money too. So the entire thing has to be meaningful and has to make sense. And so I've seen firms where like their cash commitment might only be 1%. And then they might have another 1% that they're intending to use fee waivers where the management fee converts it to. So, but it's still meaningful to them, right? Maybe they didn't get any carry at their prior shops, but they did, 8 deals that they have attribution for, and they're still, early career, mid career. So it's really got to be a case by case basis, frankly.
Yeah. What are some other green lights, green flags that you look at?
The significant personal investment. I think maintaining fund size discipline is a huge one. Back to kind of the asset management side of the industry, there's ways that growth can be supportive. If you can, do the right size deals like you've done, or you can do more deals to get broader diversification, but not growing too fast is important. I like a cohesive and tenured team. That my kind of silly title for it is Fund 1 Upside with Fund 3 Risk. I like to see a team that's really been together over kind of 2 or 3 fund cycles. And so you can see how they've operated, how they've deployed, how they've executed, hopefully how they've realized. And it's not a team coming together. It might be a first-time fund. Broad ownership and economics so that everybody's really on the same pages. I think a risk and investment-focused culture may be somewhat tough to suss out, but you can get to it. Like a lot of times what they'll do is they'll lead with their mistakes, like what deals didn't go well, what lessons were learned, as opposed to a firm that starts with the X or the one outlier great return. So all those little things to me kind of back to the little flags lead up to one big potential for outperformance.
That's interesting. So you've actually seen decks where they kind of lead with their mistakes, and they kind of say,
hey, not just in the deck, a lot of times in face-to-face meetings. And you can see when a manager was really frustrated with an outcome and still disappointed that they made that mistake, and it's hammered home to the rest of the team what lessons learned and we'll never make that mistake again, versus a firm where they kind of gloss over their mistakes or don't even really address them. There's a big difference.
You kind of have this like F1 score, if you're familiar with that in data science, where you can calculate your sort of your false positive rate.
Yeah.
Where you decided to get into a deal and you shouldn't have. And then you have your false negative rate, which is like the deals that I decided to pass on that I should have been in. And, that's also called your anti-portfolio.
That's a big thing for me, is avoiding the false positives. And so like I track how my funds have performed historically relative to their vintage year benchmark. I'd rather chop off the fourth quartile funds completely and then look like I have no skill in selecting between first, second, and third quartile than have a lot of first quartile and maybe a lot of misses in the fourth quartile. Like that's easier to do. It's consistently avoid the bad ones, as opposed to really, I think it's really difficult to pick funds that are consistently better than average, or at least better, top quartile. That's very difficult.
That's an interesting perspective, as a VC who invests in startups where a lot fail and it's a power law. I think when you're kind of looking at the portfolio level as an LP, like the way you look at funds, is it's more important of what you're saying. What I think of what you're saying is to not be in that bottom quartile. Let's try not to pick any funds down there in that bottom quartile. Yeah, we're going to get some first, second, and third quartiles, but let's try to avoid the bad ones.
For me, that's been a lot easier to do. Like what looks like a fourth quartile fund is easier to predict than what looks like a first quartile fund. A first quartile fund, second quartile fund, I mean, you should pick more than average just by chopping off that left tail, but it's very, like my track record is like 10% bottom quartile and then 30, 30, 30. Pretty hard to distinguish between those top three. That I can consistently replicate, but that is sort of the opposite of just like a VC portfolio. But if you're building a portfolio, you'd still want to tilt into the funds that at least get enough within the power law distribution to have the big upside and have the good fund returns. To me, that's like thinking the difference between an allocator really and like an investor. Like I've got to allocate, I've got to control the misses.
Yeah. I think about this a lot too. I mean, in VC, it is a power law. And, so you're trying to get into the startups that have the highest chances of becoming these, 100x opportunities, because I'm looking at early stage stuff, right? These are 10 cap companies I want to see become $1 billion companies. But part of me is also wanting to avoid the ones that will go out of business, right? Pretty easily. But there's this balance between kind of risk aversion versus risk seeking. It's an interesting kind of dilemma. Sometimes you kind of want to go for that founder has a strong force and a big vision. How do you think about that at the fund allocation level?
I mean, venture is the one segment of the markets where I think that's the hardest to do. And I think you probably think about it a little differently than the average venture capitalist does. So you kind of have more of that mentality of avoiding the losers. But there you do have to have the portfolio management. So to me, like where I'm looking in VC today is evidence of, hey, we're disciplined around this. We don't just throw money at the most recent fad or trend. We have some sort of valuation discipline. And frankly, managing to exits. The IPO market it's hit or miss just in general, but it's worse the last 20 years than it was the 20 years before that. So thinking of ways to create liquidity and just being a disciplined portfolio manager, aside from, hey, we've got some great things with great upside potential. To me, like those are super important.
Let me give you two different scenarios for like a VC manager. You got one VC manager, they got a bunch of zeros, right? I mean, almost everything is a zero because, they're investing in founders that are trying to, go for the big fad idea, call AI right now, right? And they have one big winner, X, right? They got in at a 10 cap, and exited at 10 billion to Google or something like that. But everything else went to zero. So they have a 10X fund. You're like, wow, that's really good. That's like top 5%, top decile, whatever. And then you have this other manager who's more disciplined. He kind of approaches it like you. He's trying to minimize his bottom quartile startups. And most everything was like 10X. So he got into a bunch of 10 cap companies. On average, they exited for 100 cap. And he also has a 10X fund.
Yeah.
Or she. Yeah. Which are you happier with as an LP?
Of those two scenarios, there's no question I'm picking the second one because there's more likely that the next fund for them will look more like the first one, right? It's skill versus luck. That first one, yes, that's a great outcome, but there's less evidence that they can find another 1000X or whatever the next time around.
Yeah.
And if they don't, the fund return is really bad. Whereas the second one, okay, maybe they have one or two more whiffs and they don't have the top end outcome, but it's more likely that'll still be consistent. Now, the real tough question becomes, what if that second one is like a 4X or 5X as opposed to the 10X? And then I don't think there's a right or a wrong answer there. It's what are you looking for in your portfolio? If you're going to have a very diversified portfolio of lots of venture capital GP relationships, the first one might make more sense. But if you're a smaller allocator where VC is a smaller part of what you're doing and you have a handful of commitments and relationships, the second one, right, with the 4 or 5X outcome, not the 10X. I think the 10X one and the second one, that's preferable in all scenarios. But that second one might be better if you've got fewer relationships.
Yeah, that's interesting, right? Because if you're an LP and it depends on your weighting, right, in this asset class, right? If you're only weighted 5 or 10% versus, like your Yale and you're weighting 30, 40% in venture, exactly. You're going to calculate these risks a little differently with the GPs that you're investing in.
That's right. And I think like a lot of those considerations drive how you should approach private markets broadly. It's not just like what's the right way to do it or how does this private markets machine work. It's what's your scale? What's your percentage allocation? What's your team? What's your resources to look like? If you're bigger, you have more scale, you have more resources, you have a bigger team. Like then that first portfolio construction where you have higher octane, more relationships, you can diversify across stuff makes a lot more sense. And I found that in this industry, what describes the differences generally comes down to what those constraints are. And so everyone largely optimizes kind of the same way. It's just there's so many iterations of those different constraints.
I would love to know, as a GP who raises from people like that, you're asking questions of me, right? Like I go into a founder meeting and I have questions for them. They have questions for me. I know the kind of questions they're going to ask. And so I answer them in my intro. What's your check size? What's your process? How do you add value? Things like that. Actually, I've written something. I send it to them ahead of time. Here's everything you need to know about Team Ignite as a founder. As I start these LP conversations with these institutionals, as a VC, what kind of questions should I be asking them?
That's a good question. You should be trying to do some of the homework ahead of the meeting and figure out like what are they committing to your asset class? What are the number of relationships they have? What kind of check sizes? I think there's an opportunity for people to look at like target allocations and actual allocations and go target limited partners that are underweight their asset class. Use a tool that says, hey, you're supposed to be at 10. I know you're at 8. Let me prioritize you from an outreach perspective. Asking about timeline and process is generally helpful. I'd say the bigger the institution, more process they're going to have and just the longer the time frame. Even thinking through those constraints, what's their average check size is so critical to what they're going to be able to look at. Like I had track record at an institution where our average checks were $50-60 million and we couldn't be more than 20 or 25% of the fund. So you realistically can't look at anything that's not $250 million fund. And even that, you're still kind of right at the upper limits. So again, once you kind of figure out those constraints, it can help you identify who you should be chatting with. But the last point, like I would make to just emerging managers is there's no big institution that's really going to allocate early unless you are a spin out from, a very big credible institutional shop. But you should be thinking about building those relationships in the fund 1 period for a fund 3 raise, because there's a lot of LPs that kind of think the same thing. If you don't have a really diligenceable track record. They're going to want to see you prove it out and kind of scale into it. And it's always helpful for them to have a longer runway to kind of get to know you and see how things prove out over time. So target fund 3 for that check, but still start working on it in fund 1.
Yeah. And you mentioned earlier the growing too fast, having discipline around that growth in the fund size for venture capital specifically. And maybe we can talk about private equity and hedge funds as well. But what do you think is, when you're spinning out, you already have some of those LP relationships. I've seen a lot of spin outs that are in the $50 million range for VC. What do you think is kind of that right to 3? I've seen some. Harry Stebbins in London, he went from 8 to 100, I think, on his second fund. He's exceptional at networking, and obviously has his brand and stuff. But what do you think is like the right kind of scaling?
I think you're
between
right.
those funds.
50 makes sense. If you can get to 50, that's a very good fund 1. It's tough to get to 50 in the VC world, frankly. If you do, that's good. 100 probably makes sense, but it depends upon your strategy. If you're doing a lot of seed or pre-seed, and it just takes more and more line items to get to that, that's questionable. Or check sizes increasing, so moving down in rounds and stuff like that. That always gives people pause if you're moving outside of where you actually created those returns. I saw a similar. It was like a fund 1, but it was something like 15 million, and then their fund 2 was like 75, and then their fund 3 was something like 250. That first fund to me is almost a throwaway because they were, doing $1 million checks or something, or less, and now they're writing $5 to $10 million checks. And so, can you prove out the thesis at the same size? Buyout's a little different. 100 to 200 is usually a really good fund 1 if you get to that. But the research, I think, has shown that if you more than double your fund size, fund over fund, absent exceptional people, it's very hard to maintain the same returns. Yeah. And then there's just an upper limit that's different for VC than for PE.
Right. And that has a lot to do with like your check size is your strategy is what I've heard. If you're rocking a $10, $15 million fund 1 and you're writing 100, 200K checks, and now you're going to double that, at some point you kind of get pushed out of your asset class. Like you talk about pre-seed kind of rounds, anywhere from 500K to, 1 or 2 million, let's call it. If you have to write $1 or $2 or $5 million checks to deploy your fund, you just kind of get pushed out of what you were previously good at. Is that kind of the problem? So
I think that's exactly it.
Yeah, you've tripled or 5x'd your fund size, but now you're like a small fish swimming in like a bigger shark infested water, right? And you're not used to writing these $2 million checks into these $5 million rounds.
That's true. So persistence of performance, deal attribution at the person level or the individual versus the brand, that's part of it. Fund size, that's part of it. But it's basically, if you can condition subsequent returns based upon the same team doing the same strategy in the same market / same size, your persistence is much higher.
Right.
When you grow out of doing what you've historically done, your sourcing engine often has to change. A lot of times you're buying businesses where you were selling them in the buyout side, and multiples and things go up. Like just here in Austin, I could go buy $1 million or a $3 million business at 2 or 3 times seller's discretionary earnings. If you're buying $15 to $25 million businesses, those are 7 times, 8 times, maybe more, or 6 to 8 times. And then as you start to go up market, those multiples creep up. And so can you continue to do, not to mention the types of value creation? Everyone wants to talk about value creation, and whether they actually do it, that's probably a whole nother tangent for the conversation. But can you do the same things at a $100 million company that you can at a $10 million? I think it's a lot harder to do. You can continue to add to your toolbox and grow, but it's just easier to continue to do the same thing. But here's like the last interesting thing I've seen on fund size increases. Right around 40% or so, call it, is where returns stay the same. And if you look at
40% of growth of fund 40%. Size?
So if you raise 100 and then you come back with a 140, right? Okay. Returns stay about the same. And why is that? Well, here's a theory. Private markets grow at about 10% year over year. You average a 4-year fundraising cycle. You're actually kind of punching in the market the same size. So valuations creep up. And so you're actually kind of punching at that same size in the same market with the same strategy, kind of similar valuations. You should be able to have the same sort of returns. And that's what it shows. At 40 or 50% fund size increases, there is no impact on subsequent return. So again, that's a rule of thumb. Everybody's different, but I sort of look for that as kind of like the evidence that the manager gets it. They just kind of know intuitively where they should be, and that's the fund sizes that they raise.
Yeah, because there's a limit in your check size growth as well, and your deal velocity, right? The number of checks times the check size is your fund. If we're talking about buying preferred shares or safes or whatever,
right?
And so if you're writing, I don't know, call it 100K checks, and all of a sudden you 5x your fund size, can you write 500K checks at a similar deal velocity and win those deals? Because now you're bumping up against founders who are like, do I want this person, this team to write a 500K check into my round?
Right.
Versus a 100K check. But I think it's a little different when you're writing, when you're half the round or a quarter of the round.
You're competing with a different subset of the market, and they bring different skill sets, and they have different networks and reputations.
Right.
And then the flip side is your deal velocity just has to grow up. And we know that there's a limit to that. Like, you have to bring on more people. You have to just do more deals, which means the quality of each individual deal has to go down. So I think like there are natural limits.
Yeah.
And that's kind of shows up in those numbers.
Yeah. That's really interesting. What I like to tell my LPs, if we invest in enough early stage startups, we should hit some sort of statistical return. The way I approach it is, like, you and I both have finance backgrounds, so I think we think the same, right? I'm a VC with a finance background. I don't know how common that is, but CFA, all that stuff, right? So the way I look at it is like, if I was managing other people's money for a living, and which is literally what I'm doing as a fund manager, but
it's a little unique,
yeah, it's a little unique. It's like, how do I look at the asset class? What's the optimal strategy? Well, the optimal strategy for pre-seed and seed is to get to 150, 200 companies in that portfolio. A lot of managers don't do that because it's a lot of work, right? They do 30, maybe 40, and they kind of they go, okay, that's enough. And like, if you look at the math of the asset class, it's just not enough. You are setting yourself up for either like a home run fund, or like you're not going to raise fund 2 or 3.
You're hitting on some great points. And frankly, it's the same thing as why active management in public equities is tough, right? The math is the same. If you are the index, you have the assets that outperform the index. And with the performance of, the 7 MAGA, whatever you want to call them today, like, you have to have those, otherwise you're underperforming. And that's just what's happening. And so there's been like research that just shows, just like a bootstrap portfolio of assets in the S&P 500, like 90% of them are likely to underperform the S&P 500 because you're just not going to have the right weightings in the thing. VC is a similar asset class in that indexing should make sense eventually in that asset class. It's the law of large numbers, again, the power law. So I think you are correct in thinking that way. I'm not sure the entire industry does.
I don't think the industry's caught up with that. I think they're kind of stuck in the wave that they've done it for decades, which is like, hey, we're going to do 20 or 30 bets. We're going to have a very active role on the board, and that's how we've always done things.
That's right. That's not to say that those funds can't generate consistent outperformance. Some of them can, because they have created differentiated positions in the marketplace where they're a preferred capital provider. They have networks. They have the best looks. They have a war chest that can allow them ball control. And so it's not to say that doesn't work, but in theory, like an index approach in venture makes a lot of sense. And I think there's some interesting firms out there trying to crack that nut.
Yeah. I think it's an interesting thing, a thought that popped in my head, which are the public markets becoming a power law asset class?
I think they are an asset allocation tool. Trying to select securities in public debt and public equities, I think it's pretty decisively a waste of time. Again, it's not to say that maybe there aren't people who can consistently do it, but the amount of time and resources that have to go into doing that relative to what excess return you can get is just not a good use of time. You're better off picking asset classes that can give you a better outcome, right? Yeah. And not worrying about any selection, or trying to select within less efficient asset classes. And so that's, to me, you're spot on. There's beta asset classes, there's alpha asset classes. You need to have both, but you don't need to do both the same way.
Yeah, that's really interesting. What are some other green flags, green lights you look at when you're evaluating managers and funds?
There's lots of little things that you want to see. I think for me, success has come from starting with a no. I think most diligence people and people just in general, we have a tendency to like people more after you've met them, chatted with them face to face, like, yeah, they're smart, they're good guys, good gals, whatever. But you want to disconnect yourself from any like emotional commitment to any sort of investment as long as you can, to gather as much information. So I think most people start with Like, this is a yes until I find a no, right? A couple of no's, you kick it out. I think everything should be a no. Like, this, offset this confirmation bias and this bias to action. Don't need anything. I just don't need bad ones. So everything starts with a no. And as you're looking through all the things, historical performance, understanding people, the process, the philosophy that leads to the process, what the portfolio is, you're looking for those no's. But if you can't say no to things, like there are no red flags, this is good, this is good, you just keep ticking off things that are like, it's not a no, then you really have to dig in more. Because once you find something that you can't say no to, like, you have to understand how it works and do a lot deeper diligence. But to me, that's how you wind up with just a longer diligence period to not get emotionally connected to an investment, and then subsequently more rational decisions as a result of it.
That's a really fascinating point that you're making that I want to tease apart, which is there's two approaches. One is you start with a yes and you try to break it down to a no. You try to get to a no. And then the other approach is like, hey, you start with a no. This is an automatic no. And I try to build up a yes. And what I'd like to tell my team is there's like easy yeses and easy nos in the industry. And if it's not an easy yes, it's got to be an easy no. That's like actually the hardest thing, right? Because what you're describing is like there's all these human biases at play, right? Recency bias, familiarity bias. You meet with a founder, you meet with a GP, and you want to say yes because you like the person, right? But then, it turns out they have no ARR, right? Or they have no track record, or it turns out that fund was underperforming. Whatever the thing is. Yeah, maybe you could talk about that.
Yeah, no, that's a great point, because I think that's exactly what it is. I think it's easier to say no to something when there's like one thing that, this is a no, throw it out. But the better opportunities are often where there is something that might look like a no, but there's a lot of other things that are great yeses. And if you can disconfirm that no, that's why other people aren't committing to it, right? Like, investing alpha or excess return is about arbitraging the perception of risk and actual risk. And so if you can invest in things where the perception of risk by the market is incorrect, that's where you can get outsized returns. And so oftentimes it'll be a fundraise around, well, somebody left and, were they really critical, or there's a team change, or a bruised brand, or a fund that had, poor performance previously. If you can understand like why those things happen, and oftentimes there's rational reasons why the market is pausing, it just doesn't make any sense. Or there might have been a substantive reason that is likely to continue. But sometimes there's like really clear lesson learned, like a venture firm that had 3 partners, let's say, and they did early stage deals and they didn't do really well. But they brought in 2 other younger partners who did later stage, more growth type deals, and those all did really well. But there's like 2 or 3 fund succession kind of period where it's a mash of both strategies. The fund level returns don't look so good. The founders all take, they all retire, and now it's this new team kind of leading it. Well, that to a lot of people looks like an easy no. Like, this is crazy. 2 funds in a row, 3 funds in a row that are bad. It's a new team. The founders are all gone. But if you take the time to look and say, but yeah, everything that the new team has done has been great. And like, you'd get 3 straight 3x funds with very low dispersion of returns. So to me, it's not looking for like one red flag or one green flag. It's taking the time to find things that have harder no's. And if there's a reason why one of those no's is actually misunderstood by the market, that's a great opportunity.
Yeah, I think what you're uncovering, the point you're making, which I think is brilliant, is you're trying to find mispriced opportunities in the market, right? And a reason to say yes or a reason to say no. And everybody has a unique way of looking at that, but you have to build that up over hundreds and hundreds of looks. Like you kind of build this up and you build up this thesis. And I love how you put it, which is the same way I put it. Like, I'll get the question like, what do you look for in a startup? Like, I don't know. I know it when I see it. It's like I've looked at 10,000 at this point or something like that, and I've built it up. There's no hard. Yeah, it's
repetition.
It's repetition. Yeah.
Again, back to the research, like, I'm a research nerd, but there's research behind that shows intuition can be trained. Like, nurses who use intuition to make diagnostics and use stuff that's not necessarily on a pure diagnostic checklist, the research shows they outperform just the pure checklist approach. Why? Because they've seen it before. They've seen, I noticed this pattern of things and I'm going to suggest we try this. It's the same thing in private markets. And so where does intuition be trained? Intuition can be trained when you have clear and unambiguous outcomes, when you get rapid feedback and when you get lots and lots of trials. Well, you can have clear and ambiguous outperformance or underperformance. You can get lots and lots of trials. I mean, I'll get 100 emails a day, but it's that rapid feedback that's harder to get, which then just means you need more repetitions because you need to see something as it evolves. Back to the why LPs want to look at something for 3 years, because I can see what you do and what you said you were going to do. This is held at 2x, but we know we're going to sell it at 3. Do you come back a year later and sell it at 3 or sell it at 5, or do you sell it at 1.8? So that, that intuition, it's really pattern recognition that needs to be informed by lots and lots and lots of reps over time.
Yeah. Do you have any memorable due diligence processes that you've run that you developed a unique insight or lesson that was unexpected?
Yeah, there's lots of little unique things, and I probably don't want to name too many managers specifically, but I'll say just personal interactions with the team is valuable. Back to the tendency, like you have to fight the tendency to dislike everybody more after you meet them. But there are cues and things that you can see, how they treat people, how they talk, and if it's consistent in a sales setting versus a kind of a real world setting. Just a couple like memorable snippets. I got a 15-minute yoga instruction from Barry Rosenstein at Jana when I was on site. He had serious back injury. I had a back injury. And so he noticed that I was uncomfortable in my seat. He was like, come with me. So I got a 15-minute lesson from him and some things. And actually, there's a couple of things I still incorporate every day. But he's shockingly strong, by the way.
So this is a manager of a fund and you're at his office.
Correct. Yeah.
And he sees that you're physically having some discomfort. And he does yoga. So he's like, hey, let me teach you some things.
Yeah, exactly. Wow. Let me help you out.
And that's, that's memorable. It's unique.
It's a unique lens into that person, right? Like, that's for sure.
Yeah. Yeah. You kind of like, you see beyond. When I'm assessing a founder, it's like, what's their why? And like, what's their how? How, like, I think you were teasing part that is like, how do they treat people? How do they go about doing things, getting things done?
And it's, I call them the 3 I's: intelligence, intensity, and integrity. Not necessarily in that order, but I want to see, like, to me, and I've learned more about Barry afterwards, but like his commitment to yoga and how many hours a day he puts into it. Like I said, he was incredibly strong. Like, you shook his hand and he's a thin guy, but all those little things, you can get more of that in just informal personal interactions. And so it's still important to like go meet the people, kick the tires, have to be aware of like those behavioral kind of tendencies to like them more. And you have limited bandwidth to go. But I think it's super important. I've been at places where you can't take lunch or a meal with a manager, and that's just silly to me because the amount of information you can see when someone like yells at a waiter for getting something wrong, or is just otherwise super polite and like friendly, like there's value in that.
So let's break apart the 3I framework. I haven't heard that before. Maybe you take them one by one.
Yeah, intensity, intelligence, and integrity. Integrity to me is, it's very simple. Like, you just have to do what you say you're going to do. This industry has lots of people that are very good at making money, but good at making money for themselves, maybe not necessarily for others. And so that's table stakes. Not super easy to suss out, but I've used like personality profiles, and there's reference checks and all sorts of ways you kind of get to that. But that has to be there in place. Intelligence to me is very important, but I think it's more knowledge and less kind of raw brain power. So if you think of intelligence, there's crystallized intelligence, which we call knowledge, and there's fluid intelligence, which is kind of how we think of brain power. They're both important, but you get more bang for your buck on just the information side. And so demonstrating that they know a lot about what they do and they have expertise in their markets is super important. And then intensity's a little bit more amorphous, I would say, because you want people that work hard. You want people that love what they're doing. They should be the first one kind of there, turning on the lights, and the last one. But it's got to kind of border on obsession. It can't like tilt in the full, because you need to be more well-rounded. I mean, you have to have interests outside of what you're just purely doing. You can't just do that, 150 hours a week. Like, people will burn out. And so there has to be this. But you do have to work hard. The greatest investors are absolutely working harder than most of the people around them. So that's really, I like the little, 3I kind of anagram part that you can get from just those letters and make it memorable to people. But that's the key characteristics that I'm trying to get at. And I did this before I heard the Warren Buffett quote, but he said something to the effect of, you want people who are honest, who are smart, and who are hardworking. And if you get
those are the three I's. Yeah.
Right. It's the same thing. And if you get the last two without the first one, you really don't want to work with those people or something to that effect.
Yeah.
I'm like, wow, okay. I feel kind of validated in looking for those characteristics.
Yeah, I love that. You've kind of done some thinking in behavioral finance, decision making, cognitive biases. How do you guys work to mitigate these biases in your decision making?
It's very hard, and there is no perfect. Like, you cannot just push a button and get rid of them. They're always going to be there. You're always going to be fighting them. And I think the biggest tool is just an awareness of them, just like an understanding of what these different biases are and how they impact your decisions. I think confirmation bias is sort of like the biggest one. So we've talked about like putting off a decision into the end, trying to, use numbers wherever possible. I implemented personality profiles because I found myself, again, thinking, wow, she's really smart after you meet them. And it's totally subjective. So wanting to put more objective things in place where you can quantify it, put numbers around it, that takes a lot of that out. Dispassionately debating things, having lots of eyes on them. I think like one way to manage those biases on a committee is using what I call like a rules and responsibility matrix, where you literally put everybody on the team and then you put all of the decision points that you have. I think it's Ray Dalio who also says like not everyone's opinions should be weighted the same. And I think that's, when we have a committee where there's 3 people who vote, it's effectively all weighted the same. But you should literally go through this and say who's the best at these decisions and who can bring the best information. Like, we want so-and-so on these decisions every time. Management, a lot of asset managers do this by having like sector heads, for instance. And so they're in those decisions. But if you take the time to sit down and take that rules and responsibility matrix, you can do a better job of like making sure not everyone's opinions are weighted the same and trying to boil it up to the best as opposed to watering it down to the worst. What I've found is in a lot of cases, working together in a team is like running a relay race. And there's 2 approaches. If you want to hold hands and everyone runs all legs together, you're going to be the slowest you can possibly go. And a lot of times, like unanimous decision making, that's in effect how it works. You're actually boiling down the decision to the person less comfortable and less informed on something.
Yeah.
You have to have enough division of responsibility and delegation so that those authorities are pushed to the people that are the experts, which, back to the relay, it's like everybody's running their own leg. And then you get the whole, and there is an incentive to run your leg the fastest possible because that's how you make the team the best. So that's the problem in teams, is incentivizing sort of personal performance, but then maximizing team performance.
So you transitioned to Caprock. How would you describe that transition, key reasons, and how that culture and investment philosophy aligns with yours, or the things you learned there?
Yeah, so I'd say like one of the big trends in alternatives just in general is this democratization of alternatives and the increasing access of private markets to individual investors, high net worth investors. It's as big as the institutional assets under management. It's growing twice as fast because it's underallocated. And if you fast forward, another decade or 2, it'll probably be multiples the size of the institutional industry. So having kind of seen this for a while, wanting to take what I've done in, private markets / alts and sort of bring that to the individual investor space and be part of it, just wanting to help people access these complicated things. That's really what I wanted to do. Where I think Caprock specifically has a couple of advantages. Caprock's already, at scale. The firm is, 11.5 billion in assets under management, 4.5 billion in committed capital to private markets. That can allow the firm to act like in aggregate, like an institutional investor, and you can do things at scale. There's benefits of that. And so I think that's what we have in place at Caprock. Specifically, Caprock has a couple of advantages too. It's not just already allocated those things. And so that's kind of like preaching to the choir as opposed to trying to convert non-believers. That's a lot harder, but it's an open architecture platform that is just a fee-only advisor. And so you're seeing like products emerge in the industry, which kind of gets back to the problems that existed at the warehouses, higher margin businesses, commission for selling specific things, et cetera. That's not the case in a fee-only asset or a wealth manager where there is no higher margin business. And so Caprock has that philosophy. And again, back to just the importance of private markets. It's like a third of our client assets because I think you can generate excess returns there. So
right.
Yeah, that's what I found to be the case.
Especially if you're patient. right? If you want
You have to be
liquidity,
patient.
yeah, you got to be patient.
That's underappreciated. I'd say that's the biggest risk, right? Wanting to make a 10-year decision based upon 2 years. So what have we seen in the last 2 years? Well, the S&P has absolutely killed it. 25% kind of annualized return. No private markets are going to keep up with that over a 2-year period. But the most recent 10-year rolling returns, private markets are still outperforming public markets.
Right.
So it's there. You have to be patient. You have to commit to building it over time.
Yeah. Well, I like that. And I think that's a little bit of the hangover right now from venture capital from 21 is so much was deployed and people are like, wait, I have no liquidity and no DPI and this stuff takes a really long time. And I'll just go to public markets and, high yield bonds and treasuries now because interest rates are high. And paradoxically, yeah, so now I have less funds to deploy, but I'm also able to get into the best deals because everyone's hurting to try to fundraise right now. So you're able to get into better deals. And so it's just like this fear of greed thing that happens over and over again.
That's exactly right. Yeah, it's people making the wrong decisions at the most inopportune times. And so
yeah,
now is when you should be leaning into incremental allocations in the private markets. But a lot of people are doing the opposite. So
right.
Educating our clients is part of what we do and trying to help manage expectations appropriately and set those timeframes. I mean, you really have to not look at it for a 1 or 2 year period. And then you don't really get much information content into years 4 or 5, whether or not it's actually working. But you
Right.
still have to be thinking for that, 10-year real evaluation period to matter.
Yeah, I love that.
That's tough to do. I mean, it's tough to do.
Well, Chris, I really enjoyed the conversation. I feel like we ran out of time. We'll definitely have to have you back on at some point in the future. I'm sure anyone listening will get a ton of value from this.
Yeah, thanks, Brian. Glad to be here.
Yeah, thanks.